Hello everyone, how are you? I hope you're all doing well. Today we are going to learn about the hedging and risk management. Let's get started. In the freight forwarding industry, companies face various uncertainties such as fluctuating fuel prices, changing currency exchange rates, and unexpected operational disruptions. To maintain stability and protect profits, forwarders must apply effective financial and operational strategies. Two of the most important strategies are hedging and risk management. Hedging focuses on minimize financial risk caused by market market volatility, while risk management involves identifying and controlling potential risks that may affect logistic operation, financial, and reputation. Risk management we can see for all risks, but for hedging, just for financial risk. By combining both approaches, freight forwarders can achieve greater financial stability, ensure smoother operation, and enhance customer confidence in their services. Okay, I hope you have understood about the general concept for the differences between hedging and risk management. Hedging just for financial risk, but for risk management for all risks. Hedging is a financial strategy used to protect a company from losses caused by market fluctuation, okay, such as in fuel prices, currency exchange rates, or freight rates. Okay. Hedging involves the financial fuel prices, okay, involve financial currency exchange rates as well, and freight rates as well involve financial. What the purpose of this hedging in this freight forwarding? To minimize the impact of unexpected cost increases or price volatility. If you know in the market the price sometimes increasing and sometimes decreasing, depend on the situation, geopolitics. The example in freight forwarding, fuel hedging. A freight forwarder signs a fuel price contract with a supplier at a fixed price, for example, $90 per barrel, to avoid losses if prices rise to $110. In this case, you just pay $90 per barrel. If the price in $110, in this case, you have contract with a supplier fuel. In this form contract, it said the price per barrel just $90. Okay, and if you know the contract may be for 6 months or for 1 year, you can imagine you are a freight forwarder and you need shipping line, and this ship needs fuel for delivering your goods from origin port to destination port. Okay, and you have a contract involving this price of fuel. Although the price in real condition until $110, you just still pay $90 per barrel. So it means it can help you in a uncertainty condition. Okay, I hope you understand for this explanation about the pricing. You just still pay $90, although in the real condition the price of fuel is $110 per barrel. Next, the example hedging for currency. When a forwarder pays carrier in USD but receive payment from customer in local currency, for example ADR, they can use forward contract to lock the exchange rates. Okay, I will explain you more about this currency hedging. In this case, you are as freight forwarder and you get customer from local, for example from Indonesia, and your customer pay to you in ADR, and you are as freight forwarder, you pay to carrier in dollar. Okay, and you have to log the currency to your bank. Okay, for example BBS and extra, you just pay in a first contract. For example, you say to bank, because bank will pay to shipping line, and in this contract with bank the nominal, for example 1 USD 16,000 in the first contract, like this. Okay, and if the fluctuation of this currency become 17,000 ADR each 1 USD, you just pay, you only pay you only pay 16,000 ADR. It is suitable with you in the first contract. Okay, next go to freight rate hedging. Forwarders make agreements with carrier to fix freight rates for a certain period, preventing losses from sudden rate increases. Okay, you are as freight forwarder and you have to have contract with carrier in a periods. Okay, I hope you understand about the explanation of this hedging. Next, go to risk management in freight forwarding. Risk management is the process of identifying, assessing, and controlling potential risks that could affect logistic operations or financial performance. Types of risk: operational risk, cargo damage, loss, or delivery delays. Okay. Financial risk, fluctuating transport costs or currency exchange rates. Legal and compliance risk, incomplete documents, custom violation, or export-import regulation issues. Reputation risk, customer dis- dissatisfaction, or service failure. Okay, the example of this risk management: cargo insurance. The forwarder insures all shipments against loss or damage. If goods are damaged during transit, the insurance cover the cost, not the company. Okay, cargo insurance. So you have to have relationship with insurance company to handle if any problem with your shipments. If goods are damaged during transit, the insurance will cover this accident. Operational risk plan. The company prepares a backup transport route if a port is closed due to the weather or strikes. And then shipments are still delivered on time. So if you are customer, don't worry about that. Compliance check. Before exporting, the forwarder verifies all documents, invoice, packing list, export permit to avoid customs problem. Reduce the risk of shipments delays or fines. Compliance check. Partner assessment. The forwarder only work with reliable carriers and agents that have good safety records. Minimize operational failures and improve service quality. I think enough for this explanation about the differences between hedging and risk management in freight forwarder. If you have any question about this, you can comment on below this video. Thank you so much for watching this video. Don't forget to subscribe, like, share this video to your friends. See you next time. Bye bye.